You're listening to The Capital Table. Private capital markets have been evolving for many years, but never more so than in recent times. Take a seat at the Capital Table with leading experts discussing insights into the private equity and M&A worlds, and take away the knowledge you need to excel in a rapidly changing marketplace. We know this is one table you'll leave feeling full and satisfied.
Everybody, welcome to this episode of The Capital Table. Today we're on our second of a two-part series on the independent sponsor edge, positioning for competitive advantage. Of course, glad to have back with us Paul Marino with Sadis & Goldberg and Drew Brantley with Frisch Capital. Introductions, Paul, we'll start with you.
Great. Thank you, Steve, and thank you for having us back. Paul Marino, Sadis & Goldberg, as Steve said. I run our corporate and M&A group. We have a specialty practice in independent sponsors, middle market and lower middle market private equity.
Drew?
Hey guys, Drew Brantley here. Frisch Capital. Steve, thanks for hosting us again. And Paul, great to see you again. We're a boutique investment bank. We've been around for next year will be 30 years that we've been doing this, working exclusively with independent sponsors, helping them raise equity and debt for their deals. And we're also co-investors in the deals we do as well. So we're excited to be here.
Thanks, guys. Well, let's dive into it. And for our audience, again, episode 1, we covered how sponsors are winning deals without committed capital and strategies for underwriting growth and value creation when multiples are high. And in this episode, we're going to kind of get a little tactical on how to convert that into a winning and successful deal. So, Paul, let's start with you as we talk about the independent sponsors and this environment we're in, again, with growth and value creation front of mind, multiples still high. So talk about some creative structuring avenues that our independent sponsor community can think about as they're trying to bridge these valuation gaps in this market.
Yeah, let's just go rewind the tape a little bit, Steve and Drew, and talk about, one particular aspect is earnouts. Earnouts, from when I first started practicing, through maybe, 5-6 years ago, were very taboo, and people would associate them with litigation immediately. But the reality of it is that earnouts have a place in a transaction, and specifically where a seller really has a number in their head that they want to achieve, and the buyer wants to buy the business but might not feel that the business proves out at that dollar amount. An earnout can really help bridge that gap, and if they're structured properly, and this is really where people had a bad experience with them, where it was almost like a gotcha type structuring previously. But I think over the last 5, 6, 7 years, we've had very willing buyers and sellers in the process to really try to achieve a goal, and that goal would be hitting that dollar amount because everybody wins. I think that you've seen it adopted more, and the drafting has become much less obnoxious, right? I mean, it's not set up for people to fail. Drew, would you say that that's what you've seen as well in your transactions?
100%. I've been saying, like, earnouts are in vogue these days, especially to bridge valuation gaps, but also where companies are saying, hey, next year and the year after, these are the numbers that we're going to hit. And so a lot of buyers or capital providers or independent sponsors are saying, great, sellers, let's put your money where your mouth is in the form of an earnout. If you believe you're going to hit it, then let's defer some of the payment until you hit it. And I agree with you, Paul. I think today, what we always tell our clients, and we're not attorneys like you that are maybe structuring it legally, but we say simplistically, you got to be able to understand it, and it needs to be achievable. It's got to be simple. If it's a Rube Goldberg equation that is just, impossible to understand, that's where I think, to your point, historically, things have been set up for, litigation or failure out of the gate because they're almost too complex to even understand how to hit it. And so, we always tell people, make it simple, make it, numeric, a lot of times, at least something where you got to earn into it to where there's got to be some modest growth to be able to hit it. If if the EBITDA is eroding or the company's not performing, you don't want to pay out an earnout. So there's got to be some type of incentive for it to grow, but you can have some tiers to it. But make it simple to understand and make it aligned to where everybody feels like, hey, if you win, we win. We're happy to do this, but make it simple.
Yeah, I mean, let me just put a pin in that, and then we can, Steve, we move on if you'd like. Is what we do a lot of times is we'll draft it out, and then we'll have somebody from our funds group or a paralegal or a litigation guy, read it and be like, do you understand the waterfall on this? Or do you understand the mechanisms of how it works? And if they don't, then we know that something's wrong, because you really want to make it, simple to understand. I mean, the inputs might be different, right? But you want to, mechanically, you want to make it simple to understand.
Yeah, totally.
Yeah, and I was going to add, that's what we're seeing certainly as we're advising clients through getting deals done, that, and it has changed. I think you're right on the time frame, Paul. The last 7-8 years, we all learned a lot of lessons in the time period before that, and I think making it clear, as you said, and Drew said, and also I think we're advising that just to make sure, as we're reading it from a financial standpoint, that there's no traps we see, tying that back to the diligence and obviously the accounting terminology and other things that I think it's become more sophisticated. So I think you guys are both spot on there.
Yeah. And I think the other thing that we see a lot of, just talking about, ways to structure stuff while we're on the topic, seller rollover is super important these days for, I would say, a lot of our deals that we're doing with independent sponsors. And usually the dynamic there is, especially if the seller is staying on in some capacity, especially if they're going to continue to be the CEO, and or if they've been heavily involved in the business. Obviously, there's exceptions to the rule where it's not necessary. But I would say in general, most capital providers that we know, they like it when there is some alignment and skin in the game from the old seller and the old owners going forward, because they have an institutional knowledge of that business. They have relationships with the customers, how the business operates, everything about it. That's what they have, and that's what they've created and built. So they want some alignment to where if they need their help, they're going to be willing to jump in there. So I think a lot of our deals, we encourage sellers, independent sponsors, at least 10% rollover, if not 20 or 30%. Most of our deals, honestly, are 20 to 30% rollover equity from the sellers. And I get it. There's some sellers that they just want to cash out totally and retire and move on down the road to greener pastures. And for some buyers, they're okay with that. But I would say most of the folks that we're working with, even if the seller wants that, they're not willing to give them that because they really want some of that alignment in there. And it doesn't have to be the majority of the money, but something to get them comfortable that, like, hey, you're not just we'll give you this big wad of cash and then you're going to head off to Tahiti and never show up if we need to ask a question. So.
Absolutely.
Yeah, Drew, that's a great point. And one of the issues that you're seeing now is a lot of sellers, right? So there's two types of sellers, generally speaking. It's the seller that really wants to cash out, and they generally tend to be chronologically, age-wise older. But then, guys who want to roll over, and what we're seeing is people want to sell and roll over a lot of their cash into the new business, into the platform. And, and that presents a structuring problem because, the buyer wants to have, control of the company, the platform, et cetera. And, we're depending upon how you're valuing it, et cetera, but I'll tell you, it's an interesting dynamic because it creates a unique structuring opportunity, whether you roll it over into some type of just profit interest and it carries no voting and has an equity component, et cetera. So there's a lot of moving parts, and mostly because people view the rollover as a means to take another bite of the apple, and they believe in the company.
100%.
Absolutely. Yeah, and I think tying that to the overarching theme of this 2 episodes, for our independent sponsor community out there, positioning yourself for competitive advantage. Certainly what we're talking about here are common tools that private equity funds are employing. In fact, many private equity funds, will only or with only rare exceptions, do deals without rollover and other techniques that we're talking about. So to be competitive in this market, to our independent sponsor friends, these are certainly important tools to keep in mind. So then driving towards getting the deal done, and Drew, let's start with you talking about, and this is obviously something you in particular do on a daily basis, helping them build credibility with lenders and investors front and center on your business, but also with sellers as you're advising them, and that's obviously something we all do. But let's start with you on your thoughts on that, Drew.
Absolutely. One of the things that comes up a lot with independent sponsors when we're talking to them is they want to be able to provide some certainty to the sellers that they can get their deal done. And this is it's kind of there's an imperfect solution here, but I'll give you my thoughts on kind of, how we go about this. And because keep in mind, like, a seller wants the confidence that the money's there and it's going to close tomorrow. And especially if there's an advisor involved, their incentive or their drive is to get, ideally the most value for their customer monetarily, with the least headache and hassle, and get it closed in the fastest amount of time. An independent sponsor or a buyer tends to want to pay a fair price or a below fair price. They want to take as much time as they need, and they want to, be able to feel the freedom to do what they need to get the deal done. And so there's always going to be that kind of dichotomy between, the two parties. And so I get that. And so I think for us, like, a lot of the times what we're doing with independent sponsors is we love to get involved on the front end, really helping look at the deal with them on the early side, so that if it's something that we can advise them on, hey, structure, like, here's what we think is going to help set you up for success on the capital raise side. We love sharing that knowledge on the front end on our time and dime, because it's going to help everybody's life, whether we're working with them or not. But then on the for the independent sponsor, really talking to those sellers and helping build that trust that, like, look, we've got a lot of capital providers that we work with. And this is true with so many independent sponsors. And this is the truth of the situation that they're in. They've got a lot of different investors that they can work with. What we all know on this call, the three of us and many people that are listening, is that, a support letter doesn't mean that a capital provider is going to actually get that deal done, but a seller feels like, oh, that means the capital's there and the deal's done. It's technically worth the paper that it's written on, because it's just a support letter that says, hey, we're interested in learning more about the deal. I'm not saying that in a negative way. It's just the reality of it. And so in our mind, you really have to go below that. You have to really build that relationship with that seller, build the trust that, like, hey, we're going to be the right buyer. This is our plan. This is our vision. Help them understand the network of capital providers that you work with, and also be transparent about the timing and the process. And this is where I think sometimes independent sponsors can stumble over their own feet, is they get caught up in wanting to give the sellers or the sell-side investment banker what they want. And they'll say, oh, we're going to close in 60 days. And that's just not a realistic timeline, typically, for most independent sponsors to close. And so being transparent about, hey, here's where our capital sources are coming from. Here's typically how this process works. I know it's not exactly what you want, but we're going to get this done with you. And the beautiful thing that a lot of independent sponsors have that to us is a real competitive advantage, is that they have the ability with a seller to say, look, if one of my capital partners backs out for some reason, if they find something in due diligence, we've got others that we can put in there and still get this deal done. Whereas if you sign up with this other group, ABC, funded capital group, if they back out, then you've got to step back and kind of go back to the market and figure out and restart the process. With us, you don't have to restart the process. It's just us bringing the other groups in. So I know that's a little bit of kind of the philosophy and also kind of how the discussion can go, but I think it's also just the reality of the situation that independent sponsors are in. And so I'm just acknowledging, with honesty, where both sides are coming from, but also hopefully some things that can help when they're communicating and working with sellers. And that, I just believe honesty is going to get you so much further than just telling somebody what they want to hear.
Yeah, that's a great point, especially like the angle that a reality that you just mentioned, that they are obviously talking to multiple capital providers to get the deal done. So that ability to switch gears if one drops out is really an important point for an independent sponsor community to lever to play. So, Paul, your thoughts on building credibility with both sellers and lenders and the investors in a deal to get it done.
Okay, yeah. So, Steve, that's a great question, and credibility is earned, not rewarded, or awarded, I should say. It's earned, and the way you earn it is you have to know, if you're going to buy a platform and that platform they are there, it's a QSR or they make cups or whatever they're doing. You need to really know the industry and not just know the numbers. And that's the first part. The second part is you have to have a clear line of sight of how you're going to not only increase margins or EBITDA, right, increase revenue and profits, but also what's your exit? How am I going to get out of this? Who's going to buy this company after I buy it? So I'm going to take it from point A to point B, but where is point C? And how are we going to get there? And you have to be able to explain that. And the sponsors that can do that are very successful. The sponsors that stumble around that point, they're just not. And and I think the same thing with private equity. To be quite frank with you, I think private equity, one of the things that it's having issues with is exits, and the reason why is because when they buy something, it looks great, but everybody, not everybody can be Warren Buffett and hold things, ad infinitum. I mean, you there has to be a point where people are there's a monetization or some type of exit.
Absolutely. So, Drew, one contingency, I think, as you focus on the sellers and lenders, you didn't touch on was the capital providers and how independent sponsors build credibility with that group. Let's wrap up with talking about that.
Hey, look, it's a great question, Steve, and thanks for bringing me back to it. I think building credibility with capital providers, there's a couple ways you can do it. Obviously, there's the objective way of looking at a track record and people pointing to results that they've gotten, whether it's deals they've done as an independent sponsor or firms they were a part of before, or companies or operating experience. You can easily look at that stuff, and that automatically kind of builds credibility when you look at the numbers and the metrics and what somebody has accomplished. But then there's also the credibility around a specific deal and or a thesis. And that's where I think independent sponsors can really build a ton of credibility and trust that they're going to be a good partner for a thesis when they go deep on a thesis for a specific industry or niche. And so some independent sponsors want to be more agnostic, take anything that comes over the bow, and that's fine. Plenty of people can do that and find success at it. But where we find a lot of success with independent sponsors and what we really love seeing is when people plant a flag in the ground, they have a thesis, and they fish that pond deep, so to speak, to use the metaphor. And so they really spend time getting to know capital provider, or getting to know a thesis, an industry, talking to sellers, getting super smart on a space and a vertical, and being able to talk about it, 3 or 4 levels deep beyond just high level, which most of us can talk about any industry. And that takes a little bit of time and energy and effort, not just finding a deal and reading 2 white papers on it, but it really takes time talking to sellers and people in the industry. And that really builds trust with capital providers. That's where people look and they go, okay, even if you haven't been an operator in the space for 40 years, you understand it in a way that other people don't, because you've put in the energy and you've done the work.
And one of the things too, and Drew knows this better than anybody, and is a lot of deals happen because sponsors stick around the hoop for a long time. So you might have a broken process or what have you, a busted deal, and it goes to a sponsor because they've stuck around the hoop for a long time. They've got to really know the seller and the seller's family, et cetera, and that and that's a big selling. That's a big selling point. That just is.
Yeah, that's huge, and I've seen it, and we've all seen it so many times over careers working with this community. I mean, I'm working on a deal right now that's already celebrated an anniversary, but I am high degree of confidence it's going to get done because of what you just said, Paul. I mean, there's been a trust built between the independent sponsor and the seller. There are reasons it's taken so long, mostly as I think more often than not happens, performance of the company and trying to get things aligned where there is a good deal to be made. So, great point to end on for our independent sponsors and, maintaining that competitive advantage is, I'll wrap it up in one word, Paul: persistence, and building relationships, so.
Yeah. I remember I had a coach tell me one time, to a determined man, no means not yet. So, if you take that approach and you just, you have a lot of fortitude and stick-to-itiveness, it really does pay off.
Yeah. Great. Final thought, Drew. I like how Paul ended that. So, any final thoughts you have for our independent sponsor friends?
No, happy hunting, guys. I think that, the deal market is definitely active, and regardless of what's going on macro-wise, independent sponsors are constantly finding new deals. So keep hustling.
Everyone, and Paul, Drew, and I, and our other friends look forward to hopefully seeing everyone at the Earnouts 2026 Independent Sponsor Symposium in Miami in January. Great place to go in January. So hope to see everybody there. It's going to be another really beneficial event for the independent sponsors and capital providers. So Drew, Paul, thank you both. And to our audience, we'll talk to you on the next episode of the Capital Table. Thanks.
You've been listening to the Capital Table. For more information, please visit withum.com. Thank you for listening.